Hiya, this is Thinking Solo. I'm Ryan DeRusso, a fee-only financial advisor. When you're thinking about selling your business, you need to understand what an installment plan is. Why? Because the buyer of your private practice will likely want to use an installment plan to pay for what you built. The installment plan can be valuable both to you and the buyer, but you should know what you can expect from a financial standpoint if you go this route. Let's get started. Using an installment plan is similar to how someone may buy a house. They will provide a certain amount of money up front, the down payment. Then they will take a loan, making incremental payments throughout the life of that loan. Included in those payments will be interest. An installment plan does the same. Your buyer will put a certain amount down, say 20%. Then they will pay a portion of the loan back to you every quarter, plus interest. How much interest will depend on many factors. It will depend on whether you and the buyer use a bank to find the loan, or if you will take on the majority of the risk around the loan. It will depend on the strength of the business you're selling. It will depend on the strength of the person's credit history that is buying your practice. And it will even depend on the current interest rates in the market at the time of the sale. As you can see, it will depend on a lot. You might wonder, why would I want to deal with the hassle? It's because the buyer for a private practice will most likely be a person breaking into the industry who wants a head start in obtaining clients. Or it's a group practice that wants to ensure your clients go to them. What neither of these two groups will have is a ton of disposable income. Installment plans allow the profits of the business to be used to pay back the loan. This allows the buyer to use the business to fund future payments. For you, it also breaks out the payments over years, say 10 years. This reduces the amount you receive every year, so you don't have to pay as much in taxes, or you can spread out the tax impact. It essentially allows you to plan the payments from a tax perspective and retirement perspective. The problem with installment plans is they do add risk to the sale, since what happens if the buyer completely muddles your business and is unable to pay? This is why it's important to know who you're selling to and have faith that they can do the job. It's also why many will go through a bank to fund the installment loan. By doing so, you will receive less in interest, but they guarantee a certain amount of repayment. If the person fails to repay, it's the bank, not you, who will take over the business. If instead you're agreeing to the installment loan and not using a bank as a middleman, you're taking on more risk, which means you receive more in interest. You will have to have a lawyer by your side to do this, but make sure to include in the contract the buyer fails to pay, you receive the business again. It may not be nearly as valuable now after the owner fails to pay, but you can try and resell it again. Let me know if you have any questions in the comments below. It's a complicated topic. This is Thinking Solo, and I'll see you next time.